Good morning and welcome to the Downing Strategic Microcap Investment Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, review all questions submitted today and will publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Judith Mackenzie and Nick Hawthorne, Fund Managers at Downing. Good morning.
Good morning. I'm Judith Mackenzie and Nick, say hello.
Hi, I'm Nick Hawthorne.
So we're going to talk about the Downing Strategic Microcap Investment Trust, and what we do is hunt value and we enable transformation in UK smaller companies. Flick through the first couple of slides and the key risks. So yeah, just in terms of a recap of what we do at DSM. So it's a concentrated portfolio. We're 12 to 18 companies, we're about 17 at the moment. And we're investing in companies under 150 million market caps at the time of investment. So we deem these as microcap companies. And we'll come on and talk about why this is such a great hunting ground. And once we've got these companies in the portfolio, we try and enable these businesses to transform, and we're trying to unlock the intrinsic value within these businesses. So we're very active and we're engaged with a long-term mindset. We say that we've got a value methodology, but we're not necessarily value in its traditional sense. We're really looking for companies that are undervalued, but most importantly, where we see these catalysts that can be driven to realise value over the long term. And I think what you can see now in this portfolio is that we're now about 6 years old. And I would say that the typical investment horizon of the companies within a portfolio, this type of portfolio, would be between 5 and 7 years. So you've got a maturing portfolio. So therefore, it's quite a de-risked entry point. As you'll see, a lot of these catalysts have already started to play out. And we've also got a bit of a discount at the moment. We're sitting on about a 15% discount. And we've got the optionality of a 2024 redemption option, which allows investors to realise value at 50%, or up to 50% of their holding at NAV. So that's quite an attractive point to be looking at DSM. There's a lot of information on the slide. I've probably said most of it already, but just to recap, we're active managers investing in between 12 and 18 underlying companies. We're high conviction, bottom up, and we're unlocking value within these companies. Nick, do you want to cover this one?
Yep. So obviously we all know the UK and especially UK smaller companies have been hit hard over the last 12 months. If you were in more expensive companies, then you felt the most pain, and that's because of the Bank of England's efforts to combat inflation. That's pushed yields up elsewhere. So it means that investors don't just need to own equities to make their capital work anymore. You could go out and buy gilts on almost a 5% yield today. So capital moving out of equities, and especially the most expensive equities, that's pushed multiples down over the whole market, but especially at the most expensive end. So that's kind of somewhat played into our hands, at least in the short term. We declined less in the market, albeit we're still down over 12 months, and that's because we own the less expensive companies in the universe. Obviously, if we look over the longer term, then we have underperformed the market, but with the setup now much more to our benefit, much more to our style, then we think that we can start to claw back that underperformance and continue to outperform. And that's especially so if we can continue to secure some exits in this weaker market, like Adept, which we'll come on and talk about, and then we can deploy that cash back into newer equities, new positions at much lower valuations. So if we look at an overview of the year to date, so the NAV is up 7%, the shares are up 14% on the basis that the discounts come in by a little over 10%. So that NAV uplift is mostly the effect of the exit of Adept Telecom, which I just mentioned. But we've also had some good other wins, namely in the newest holdings of Inspecs and Journeo. We've also had a few uplifts in some of our legacy holdings like Bolex. As we know, there's a 2024 facility whereby investors can be paid back up to 50% of their holding in the company at NAV. So we would expect, as we get closer to this point, the discount should also continue to close. As I said at the beginning there, the main movement in the year to date is the exit of a debt. We have added 2 new positions in Inspecs and Journeo. The combined book cost of those positions is a touch under 2.7 million, and the value today, or the value yesterday, was just under 4 million. So a healthy uplift on those since we've owned them. And as we'll come on and talk about, there's plenty more upside to go in those. So a good portion of the NAV upside to date is in there. And then we've made a few follow-ons as well and a few partial exits. So the key follow-ons in Fire Angel, which I think Judith will come on and talk about, and Volex, which I will talk about in the next slide. Next slide.
Okay, this is the usual pie chart that everybody has in their portfolio, but we obviously look at our sector exposure. You can see that we're pretty well diversified here. We also actually probably look at things slightly differently. We look at companies within certain buckets. So we've got where there's self-help, we've got where there's recovery, and we tend to look at those areas very much in terms of the catalyst that we have in play at any point in time. So it's not really just a sector aspect that we're looking at. Now, this is a busy slide. We won't talk through every single one of them, but I'll maybe pull out a couple, and Nick will probably come on and talk about Inspecs later as a case study, and Journeo as a case study as well. So the ones then that I'll pull out from here, Centre Media. It's been consistently delivering on its numbers if you look back over the last, well, actually through COVID as well, despite some of the macro headwinds. And I think very often it's perceived as being a bit of a glorified bunch of advertising agencies, but really it's far from that. The bulk of its earnings are coming from a subscription base. They own a very good quality title called The Lawyer, which does what it says in the tin. It services the legal market. But they also have educational exposure through what's called the mini MBA, and that's been a growing part of their business. So the key here is what they've always talked about over the last couple of years, MAP 23, which very simply means that they're aiming for 23% EBITDA margins by 2023. And that, of course, is the year that we're in at the moment. So their recent statements would confirm that they're confident in being able to achieve that. And that implies around about 45 million plus of turnover, and therefore 10 million plus of EBITDA. And it's sitting on a really modest market cap of about 68 million, with net cash of 60, and having paid out about 8.8 in ordinary and special dividends over the last year. So it's a company that keeps giving in terms of its repayment to shareholders through special divvies at the moment, but I think there's actually quite a bit more to come. We've always looked at this on the sum of the parts basis, because the mini MBA, some of the agencies and The Lawyer, they don't really sit together that well there's not much, I don't think there's much sense in them sitting together in one business. So the sum of the parts argument for us was always to the fore. Now, somebody may find the whole unit attractive, but when we look at the sum of the parts, it's far in excess of the current share price. So given that they set their goal of achieving these 23% margins this year, and I'm no doubt that they'll be mapping out what they're going to do over the next 3 years, but I do think on the basis of those good earnings coming through this year and the growth, that there's quite an interesting juncture as to why it would be sensible to look at a split up of the business at this point. The other one I'll talk about is good old Ramsden's. It's a nice steady business. This is not one that's necessarily going to double share price from here, but in this economic environment, it's quite a nice business to have in the portfolio. So just to remind you, they're a pawnbroker. They also are in precious metals, FX. So they sell foreign currency to folk going on holiday. They've got a network of retail sites throughout the UK, mainly in the north, certainly not in the southeast. And they're also exposed to second-hand jewellery, which they sell through their stores, but also online. So they've got a great footprint in the UK, but it's a business that obviously suffered through COVID, because I think it's one of our only businesses that had to pretty much shut down completely. So you're not only seeing a return to pre-COVID levels, but you've also got a really good business model when it comes to new store rollout, and the payback for new stores, which they're very careful about opening, is under 2 years, which is again a very attractive business model. So I don't think necessarily, as I say, that it will double from here, but it's nice to have in the portfolio. And really the catalyst from here is just a bit more of the same: new store rollout and just delivering consistent earnings. The FX isn't quite back to pre-COVID times. However, the jewellery side of the business, the online, is certainly doing better than our expectations. So a nice one to tuck away into the portfolio.
And I'll pick up on Volex in this slide, third largest position by percentage of NAV. By all accounts, Volex had an excellent year last year with sales and earnings ahead of our expectations and ahead of the market's expectations. So the key points for us here were that margin bounced back off those 9% lows that we saw, and actually H2 showed an EBIT margin of over 9.5%, which is obviously much healthier than where we had been, and much closer to the 10% kind of peak that we'd had before. So the next key point is that turnover held up well, much better than we thought. We had some concerns over the consumer business, given the downturn, obviously, in consumer white goods and IT hardware. But as expected, that low-cost model that they acquired in Deca, that's helping them to take share. And we noted a few significant new customer wins, which we think will continue to more than offset the decline or potential decline in kind of like-for-like volumes. So that's good news. The other segments, high speed, healthcare, EV, we're less concerned about these in terms of cyclicality. And perhaps the most important aspect, the final aspect here, is that cash conversion was much better, and that helped net debt come back down. We think that was a key concern of the market. So with more normal supply chains and more normal working capital going forwards, we expect similar levels of cash conversion going forwards as well. One of the key pushbacks we hear is that people think the company are just buying sales, buying earnings and margin, and the underlying business hasn't changed much since the low single-digit commoditized power card days. However, when we go back, we pull out all the acquisitions since 2018, we find underlying sales CAGR of 8%, underlying earnings CAGR of 25%, and underlying margin on that business of 8% versus an acquired margin of 13%. So they are buying a bit of margin, but the key here is that the underlying business is good standalone and it's performing well. So we still think that this is misunderstood by the market. And then if we jump forward to now, that's the underlying business that since the year end, they've announced the potential acquisition of a large off-highways cable assembly business in Turkey. Again, the key thing here is that this business is a lot like their healthcare business just now. It's high labor, it's high mix, it's low volume cable assemblies. It's not high volume, highly automated automotive cable assembly, which is super competitive. And because of this mix effect, this is a 20% EBITDA margin business. So it will pull the PLC EBIT margins up to north of 10% when we get to the first full year of consolidation. And again, one of the exciting aspects here is that that business has a good off-highways market in Turkey, but they haven't taken it international. And Volex management think that they can export this model and the methods to the US, where they have existing customers and existing sites, and that will help them to begin competing for off-highway customers in that market. And obviously that market is a much larger one to go for. So just finally on valuation, if we look forward to 2025, that's going to be the first full year of earnings of the acquisition. And looking at EPS consensus, about 34 cents. So that puts the shares on a little over 10 times PE today. So that's about 40% cheaper than peers. And again, as has been the case in the past, I'd expect that there is upside on those earnings as well, especially with this large acquisition, where I suspect management may well have loaded in as much cost as possible.
Thanks, Nick. We'll go on to another busy slide, but hopefully this will give you a bit of an idea as to where the value creation. We talked a little about what's happened in the portfolio over the last 12 months, but we're actually trying to now give you a bit of an idea as to what happens going on from here. I'll cover off a couple here, Real Good Food and Synectics, and I see a few questions on Fire Angel, which I'll come to probably at the end, but I'll maybe just address some of that, the catalyst on that one here now as well. So Real Good Food, one thing about our strategic portfolio of companies under 150 million market caps is that you're not always going into situations that are nice and pretty and shiny and ready to realise value. We do get our hands dirty, and where we see that there needs to be change, we make those changes. And Real Good Food was probably more of a handful than we anticipated when we invested in it first. About 5.5 years ago, we had some governance issues to deal with. We pretty much had to help change the full board. And then we started on a divestment strategy where basically, again, a bit like Centaur, there was a number of businesses that didn't necessarily fit together. And we saw that the argument here was on the sum of the parts. So actually, if we look back over that time, we've divested of over 60 million of assets, and we've used that to pay down debt, but also pay down some of our own debt, redemption premium and interest. And our main exposure here is through existing loan notes. So just to remind you, this is a business that has reiterated its ability to deliver between 2 and 4 million of EBITDA through self-help, not through top-line growth. And here we've got about 3 million of capital left, and we've got interest and redemption premium of about 3.1, but we're actually only recognising about 1 million of that 3.1 million. So if we do what the management team think they can do within this business, then there's potential upside of 2 million on when those loan notes get repaid. Now, clearly, we're part of that journey in terms of getting to that EBITDA number or aspirational EBITDA number. But given the self-help that has gone on in the business, about 6 million taken out of costs over the last 18 months to 2 years. And if you look at more recent statements, you'll have seen that the cost inflation we've managed to pass that on to underlying customers like Tesco and some of the supermarkets, and that's double digit. That's into 18 to 20% type price rises or resets that we managed to pass through. So certainly it's a business that quite clearly is on its exit route, and it's a business that hopefully when we speak over the course of the next 12 to 18 months, we'll be able to say that we've achieved that number, but probably more significantly, we've realised the asset value and the enterprise value within that business, which the assets that are sitting there include a 5-acre site in the middle of Liverpool. So we've got some levers to pull here. The other one, completely different business called Synectics. Their interims were out this week, and that showed a record order book. And this is a little security and surveillance business, and it's really sort of flown underneath the radar to a certain extent. They had a tough time through COVID. They were servicing the casino market, and obviously casinos shut down. Casinos still haven't come back to full strength yet, and that's how the market hasn't. But actually, what's happened in the meantime is that they've won contracts in infrastructure and also in oil and gas. Not oil and gas as you and I might know it, but it's surveillance of pipelines throughout the world. So these are quite big contracts, and so you've got some nice dynamics here. You've got that infrastructure play. You've obviously got a market that is quite led towards security and surveillance, and they are dominant in that space. You've got the casino market coming back too, which will be quite attractive. And so this company is really cheap, sitting on 2.8 times EV/EBITDA for 2024. It's on a 14% cash flow yield at that point. It's paying a dividend. It's got net cash in the balance sheet. I think this has gone underneath the radar to a certain extent because it used to be a bit of a box shifter, and they've spent the last couple of years moving from being box shifting to much more of a solutions sell. So that means that margins can go from 8 to 10% up to sort of 30, 40, 50%. So that migration to that better quality type of contract really has gone overlooked. And here we're really just trying to get the story out a little bit more. That casino market coming back, I think, will be driven by legislation in China that from April, all casinos have to allow government access to video recordings live from every casino table. So, the Chinese do it in a relatively dramatic way when they impose regulation, but that is a real player or a real game changer for that casino market opening back up. And here, over the course of the last 12 months, we've helped put in a new chair, and we've definitely been encouraging the company to increase its profile. I feel it's definitely the right time to start shouting about this business. So watch this space. Hopefully you'll see them coming on to Investor Meets Company very soon as well. In fact, next Tuesday at 2 o'clock, just advertising. Nick, do you want to cover off any other ones here?
No, I'll jump on to case studies, I think.
Oh, gosh, me, journey on again. So this is another cheap and overlooked company. In fact, it's rather incestuous because the chief exec here used to be the chief exec of Synectics back in the day when it was called Codnetics. So it's a business that I've probably followed for, about 7 or 8 years, but probably a little bit too small for us. We invested on the back of its acquisition of Infotech, which is a little business just down the road from it in the rail sector, back in January. So they provide information systems for the transport and infrastructure sector. And what does that really mean? When you go into your local train station and you look up and see where your train is and what time it's going to leave, it's the big boards that you'll see in Paddington and Euston. And actually, probably notice that they become far more interactive and slightly better looking. So that's the type of business that this business services. But it's not just that. They've got some great contracts. For instance, a £9 million framework for First Bus, and they also have contracts with ScotRail. They've been moving into the airport side of things, Dublin Airport for passenger transfers and Heathrow for telematics. So we see the growth being organic, but probably potentially some deals to do on the acquisition side as well. The catalysts here are macro, but there's definitely general growth in this market as we see far more information being pushed down to the passenger and also passenger monitoring. And if you look at the valuation here, it's going to be generating an EBITDA of 4 million, and it's a 30 million market cap with about 4 million of cash. And the other players in this sector are on double this rating. You look at businesses like Traxys, who have been around for quite a while, where we're also a shareholder, then you see that they're on multiples that, because of the SaaS element of their business, they really should be sitting on a higher multiple. So really, we're waiting to see those earnings come through, and we expect a re-rating. Nick, do you want to chat about on the market?
Yep. So on the market is, as it says there, it's the third largest portal in the UK. I guess kind of how it differs to peers like Zoopla would be that they're agent-owned and agent-backed, and they're aiming to be more than just a portal for their agent clients instead of for the consumer. So what we think is quite unique here is that we effectively have a 30 million turnover, effectively software SaaS type business, gets paid in advance with a 60% share of their agent customer market. They make EBITDA of 8 million quid, and they're cash flow positive even after development capex. So that means they've got about 11 million of cash, about 25% of their market cap in net cash with no debt. Yet it's valued on an EV to sales of well under 1 time. So to us, the market is implying that there's just no long-term value in this business. Indeed, if it was just another portal, then perhaps there wouldn't be any long-term value here. We've seen similar peers fall out the market, like Boomin. They spent 40 million over COVID marketing a portal which just couldn't survive. But the key here is that on the market are well down the path of effectively building out an agency in a box model, and that's effectively all the tools that an estate agent would need to manage an estate agency. So that's a market-leading portal to list on, it's a CRM to manage your clients, tenant checks, SEO marketing, and they'll do all of that at about a quarter of the cost versus an agent using the leading independent suppliers. So we think that is compelling for agents. The only issue now, which I guess was kind of unforeseen when we made our investment, is that the shares are marked down so heavily because of the state of the housing market just now. So potentially that means less agents, and potentially that means less agents willing to make a switch in this market, even though financially it does make sense for them to do so. But even if things are slow, even if agent numbers do decline, we still think that there's a good ability here via the new functionality, the value that the management team are adding in the software side, to continue charging agents more year on year. And we also think that the new homes business will continue to do well as house builders, as we've seen, they need to sell on their stock. So a bit more marketing spend, a bit more access to portal doesn't affect their bottom line all that much. So overall, yes, we think this year is unlikely to shoot the lights out with agents feeling the pain here. But this is it's a fascinating business and a fascinating business model. It's got an excellent management team, and we think it's completely undervalued by the market. In the kind of near term, in the short term, with 25% of the market cap in cash, and the business not burning cash, not expected to burn cash, and again, we kind of modelled downside situations here. It's kind of difficult to see, touching wood when I say it, difficult to see a situation where they do start to burn cash. Again, if we think about this business, they have 9 million a year, 8 to 9 million a year of marketing spend, which you can effectively switch off whenever you want. So if things do get bad, you turn off marketing. That's 8 million potentially of cost savings. Yes, you might damage the business in the longer term, but it's a nice lever to have to manage your cost base. So yeah, as I was saying, not burning cash. So we think that there's a good argument here for the company to begin potentially buying back some of their own stock at these levels.
Okay, just click on. Another one for you.
Yeah, and I'll cover off Inspecs as well. Inspecs, one of the newest holdings in DSM, and this is a company in the eyewear business. They design and manufacture eyewear and lenses under their own labels and also for third parties. The business had an awful 2022. It's difficult to think of any company that's had a worse year other than ones that have gone bust. The shares were down over 90%, and that was due to themselves almost going bust. I suspect they're overgeared. That combined with the weak consumer in Germany, especially in the third quarter last year. If we think back, that was kind of mini budget time here in the UK. That means that they did hit the covenant, and there were a few other issues as well. But the main thing here is that they have all been short term. So the German consumer is back. The debt's down, and it's down organically. It's not down via a shareholder bailout. And the issues at the lens facility at the Norval site, we think those are now mostly sorted, with customers and volumes now coming back into that site. That was a $5 million loss last year, and we think that will get close to washing its face this year. The kind of fascinating thing about Inspecs as a business is that they're in so much of their own supply chain. So they design themselves, they manufacture themselves on their own sites. They have their own labels. They have their ability to manufacture their own lenses as well. So that's a lot like the largest player in the space, SLR and Luxottica. In fact, the only thing they don't actually do is sell to the consumer, albeit that may be something that changes in the medium term. And again, that is something which SLR, like Exotica, do via their own stores and via online. But because they own so much of the value chain themselves, they earn kind of 50% margins at GM level. But if you think about then a business which designs itself, sources itself, manufactures itself, and with its own lenses, and then can also sell its own labels in its own stores, then we think there's still a lot more margin to go for here. And again, if we look at SLR, that's a business with more than double the EBITDA margin of Inspecs today, albeit with much more scale. In many ways, Inspecs to us is similar, and a similar thesis to what Volex was back in 2017. They're both global businesses with their own size to manufacture. They've got blue chip clients. They've got big margin expansion opportunity, and they have shareholder managers with skin in the game. But because of some short-term issues, they're under-earning and they're deeply discounted and misunderstood by the market. So, I guess the thesis here is obviously based on the underlying quality of the business, which we think is still undervalued today at 8 to 9 times EV to EBITDA for this year, and that compares to their own past, where they've been valued as high as 15 to 20 times, and it compares to other eyewear peers, which are valued today between 12 and 15 times in what is obviously quite a tough marketplace. So obviously what needs to happen here is we think this year just needs to be a solid year. We have to show that Germany's been stabilized. We have to show that the Norval lens facility is losing less money. Hopefully it can wash its face, and then we want to get into a meeting and hopefully beating expectation cycle. And again, we think that the expectations look fairly conservative here, bar anything else unforeseen happening in the second half of the year.
So I'll talk a little bit about the strategic initiatives in the period. So we've been quite busy, as Nick says. We've had some new investments with on the market, Inspecs and Journeo, the ones that we've just talked about here actually, and they have got off to a good start in terms of share price appreciation, which is good. We did take some modest profits in Ramsden's and Hargreaves, mainly more than anything else, just through portfolio management, nothing to do with the underlying belief in these two businesses. You've heard us talk about Ramsden's already. Their share price has gone up nicely, so therefore we've just trimmed accordingly in the portfolio, and Hargreaves really in the same vein, nothing to read into within that. And we increased our exposure to Fire Angel and Volex. And just on Fire Angel, we'll come on and talk about the strategic actions that we've taken there as well. There's now a new chair and CEO. Nick talked about 2022 being a difficult year for Inspecs. I think probably Fire Angel managed to find yet another banana skin. And the headwinds of COVID and inflationary pressures last year really affected that business far more than it did on any other portfolio company. And we were left scratching our heads a little bit, because what we found was that the management teams in many of our other companies had been quite reactive to some of those headwinds. And what we felt was with Fire Angel, that they were probably a little bit of victim, or acted a bit of a victim, as opposed to being proactive and really addressing some of those challenges head on, where there were actually levers that they could, or we felt that they could pull to have mitigated some of those headwinds. So that led to a management change. We brought in Andrew Blazy as chair, and his sidekick Neil as chair and CEO there. And if you look back, they are a team that were highly effective for us in a business called Universe Group. And there were probably quite a few similarities between Fire Angel and Universe back in the day. Again, a business that was probably a little bit complacent, but had great IP, good market position, They were a point of sale software, probably in most retailers that you would know, but a small business based in Southampton, and really it needed a bit of a refresh in terms of its offering, but also in its cost base. And ultimately, our goal there was to sell the business, and that's exactly what Andrew and Neil did. So you'll see in the most recent fundraise and statement that they are undertaking a strategic review. And for anybody that is in the know, that means typically that a business is up for sale. So we believe that the assets here, the IP, the market share that Fire Angel have, and the growth opportunities that it's got with the tech and business in particular, are exceptionally valuable. So we used that rather disappointing 2022 to refinance the business and put in some warrants, but obviously the key thing here to change the management and refresh the strategic view of the business. So I would like to think that this might not be a business that's held long term in the portfolio, but will get into a position pretty quickly with this new management team where they will be realising value. Other things in the portfolio that have been we've been up to Adept, we talked about before. We exited to Macquarie, a private equity vehicle with Macquarie at 75% upside to the holding price, and certainly we think that kind of activity will be a feature of the portfolio over the course of the next 12 months or so. And we had part repayment of our tiny loan note in Northern Broadbent, mainly because they've had some really good strong trading. Had a trading update on Tuesday, and we're very active when it comes to the day-to-day management of our companies. We're an observer on Digital Box, and I sit on the board of Real Good Food, but we're very engaged with the management teams that we have in this portfolio. Nick, do you want to summarise?
Yeah, so as we said at the beginning, we're focused on UK companies, 12 to 18 holdings, sub 150 million market cap at the time of investment. We want to be long term, we want to be active, we want to be involved with the management teams, and we want to understand the businesses that we're investing in, and hopefully we can work with management teams as well to unlock value. And again, as we said a few times earlier, why now? Well, you've got the option of the 2024 facility where you can get back 50% of your holding at NAV.
Thanks, Nick. Okay, we have got some questions.
Nick, I was going to say you've got quite a few questions actually.
Yeah.
So, I'll give you a moment just to have a look at those, and just while you do that, just remind the attendees that do please continue to submit your questions, and of course the company review them all and give responses where appropriate to do so. And of course, any that we don't get around to the review post the meeting, we can publish responses back out. If I may just hand back to you, Judith, Nick, just to go through those questions and where appropriate to do so. Just please read out the question and give your response, and I'll pick up from you at the end.
Yeah, I'll tell you what, I'll read it out, Nick, and you can answer it. How are the portfolio companies positioned were there to be a potentially protracted recession? Do you want to cover that one?
Yeah, so we hope that we're fairly well diversified. I guess our view is the UK is going to be a tougher place to be than other places, but again, we have exposure to those other places via holdings like Volex, Inspecs, companies like that. Again, if we think back to something which maybe shouldn't have, where we didn't expect to be as affected by the UK market, would be on the market. We didn't think we'd be sitting here in the kind of situation we're in just now. Thinking even back to March this year, it's gotten a lot worse since then. But I think to answer that. We're fairly comfortable with the diversification we've got. The companies are well capitalized themselves as well, especially after Fire Angel earlier this year. So, I think we're hopefully okay.
Why are we taking profits at Hargreaves? I mean, I think I explained that. It's nothing to do with the fundamentals of the business. It's more to do with portfolio tweaking, and it's quite nice to have when share prices go up that you get the ability to do that. So nothing, whatever, certainly there may have been a TR1 recently because we also hold this company in our IHT portfolios, and sometimes people holding for IHT are a demographic that are probably slightly older, and sometimes they die. So sometimes the estates do need to take the money off the table. So that's really the fundamental reason for that movement there. What do you see as the natural level of cash as a percentage of your portfolio? As appreciate you need some dry powder. I mean, we're probably slightly lower than we would normally be because we've been active in the portfolio with some newer positions, but not wanting to tell you what we're up to. We certainly feel as though we've got enough liquidity for that dry powder to be enabled. Historically, we probably run about over 10%, 10 to 12%.
Yeah, I think about 10% always feels comfortable. We're below that now. Yeah, I mean, I think you on the last question, why did we sell some HSP? We obviously had other things to invest in. We had Fire Angel to support. We had Rolex follow on for the acquisition. So those things meant that we needed a bit of cash.
Yep. What level of gearing or debt are you looking for in an investing company? To be honest, we just try and avoid it as much as we can. There's a question here about interest rates and what companies have been affected most, and those companies. Look at Fire Angel; they had debt, and they were affected by currency. So we prefer cash in the balance sheet, and situations like Inspecs that have got quite a clear de-gearing strategy, where we think that actually that could be one of the catalysts for a valuation change as well.
Yeah, I think again, it's nice to have companies with cash on the market. 25% of this market cap in cash. We've got others actually with 20% of the market caps in cash. So nice place to be. If you're thinking about levers that management teams can pull, especially in these weaker markets, well, one of those levers is to do M&A. Well, that's good if you've got 25% of your market cap in cash. You can also buy back your own stock. So that should be a catalyst when times are tough as well. But I guess on the flip side, as we said with Inspecs, debt can also be an opportunity. And in this kind of market, you see companies with debt which are basically valued as if they're going to go bust. If they're not going to go bust, then there's fantastic upside in those. And again, thinking back to Inspecs, that was 40p when people thought it was going bust. It didn't go bust. It de-geared itself, and it's now £1.20. And there's a lot more upside to go on after that. So there's opportunity on both sides. But I guess you have to pick the ones that are sustainable and the good business models.
Interesting. A couple of questions on Venture Life, which is a position that we probably exited about a year ago. Obviously, it's one that we still monitor, given that we know it. And as one question quite rightly pointed out, we were concerned about some of the governance aspects within the business and checks and balances. There has been some change there, and we're watching it. I think that's probably all we can say at this stage. But we felt as though it did need wholesale change, and it's encouraging that the board has been switched around a little bit, which is healthy, I think. That's a difficult one. In aggregate, what do you believe is the percentage upside of the portfolio to the estimated intrinsic value? What IRR do you explicitly target when making a new investment? So we're looking at companies that can double over a 3 to 5 year period, ideally. It's not necessarily an IRR target, but I can't remember the last stats that we put out, and I'm being rather careful in what I'm about to say here. But Nick, we obviously run our upside to the portfolio on a regular but not daily basis.
Yes. So NAV the last time we did it, NAV was a 40% discount to what we thought the valuation of all of our companies would be in a fair market, which obviously isn't going to happen all at one time. And I guess I would add on the IRR question, we've said 15% in the past. 15% is basically a 2x over 5 years. If we can do better than that, we'd like to do that. I guess, another way we sometimes, we do think about things is, and again, case in point being in specs, can the multiple double and can earnings double? If we get to that, there's a 4x situation there, and that leaves us lots of scope for making mistakes, which we obviously do.
Thank you, Nick. Look, great questions. That's us at 45 minutes. So I think we'll wrap up there. And if there's any others that we haven't answered, we'll get back directly on the platform.
That's fantastic. Thank you, Judith. Thanks, Nick, for addressing those questions. We can, of course, as you say, we'll review those and we'll publish any others back out. Judith, perhaps before redirecting investors to give you their feedback, which I know is particularly important to yourself and Nick, if I could just ask you just for a few closing comments, that'd be great.
Yeah, I mean, look, this is a really interesting part of the market. I think, we were talking, Paul, just before we came on here, and you're seeing this year, you're seeing one company a month leaving the market. In fact, it's more than that in the market. And I think through my career, I don't think I've seen so many companies falling into administration and being suspended and coming off market. So in some ways, you can be quite negative about the overall UK market, but that provides such a great hunting ground for investors like ourselves. There are not that many people hunting where we are, and that means that you can get these quality companies, the companies like Synetics, Journeo, Inspecs that are sitting on single-digit type multiples. You put some strategic catalysts in place, and you're not dependent on the market necessarily just valuing something slightly better. We are masters of our own destiny when it comes to looking for strategic value realization. And I think, in this tough market, that's quite a good place to be. So we're buying cheaply. We've got a maturing portfolio that's certainly evidencing performance. The trust itself is sitting at a discount, and investors at this point are getting the optionality of that 24 facility. So, although life might seem tough from a macro perspective, we're actually pretty excited about the prospects for DSM.
That's fantastic. Judith Smith, thanks indeed for updating investors today. Could I please ask investors not to close the session? You'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the team. On behalf of the management team down in Strategic Microcap Investment Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.